Today, we will talk about 3-2-1 buy-down mortgages. A 3-2-1 buy-down mortgage is a type of home loan that allows homebuyers to obtain a lower interest rate for the first 3 years of the loan term. The interest rate is reduced by 3% in the first year, 2% in the second year, and 1% in the third year. After that, the original interest rate applies for the remainder of the mortgage term. The cost of the buy-down is often covered by the seller, homebuilder, or lender. The savings experienced by the homebuyer in the first 3 years of a buy-down mortgage term represent the cost of the buy-down mortgage. The cost is typically covered by someone other than the buyer, often the seller, homebuilder, or lender. For example, motivated sellers might be willing to pay the cost to attract buyers and close the deal. Real estate developers also offer buy-downs as incentives for potential buyers of newly built homes. It can be risky to get a 3-2-1 buy-down mortgage on the assumption that your income will rise sufficiently over the next 3 years to afford the mortgage payments when they reach their maximum level. Potential homebuyers should consider how secure their job is and whether unforeseen circumstances could make their house payments unmanageable in the 4th year. They should also evaluate if paying the cash up front for the buy-down is worth the several years of lower payments in return. The cost of a 3-2-1 buy-down mortgage is the total amount that the buyer saves over the 3-year period of lower rates. Typically, the seller, homebuilder, or lender pays the cost of a buy-down mortgage, but there are circumstances where the buyer might pay it, such as when a company is relocating an employee to another area. A 3-2-1 buy-down mortgage can be a good deal for the homebuyer, especially if someone else, such as the seller, is paying for it. However, buyers need to be reasonably certain that they'll be able to afford their mortgage payments once the full interest rate applies from the 4th year onward. Here are 4 key takeaways. 1. With a 3-2-1 buy-down mortgage, the borrower pays a lower than normal interest rate over the first 3 years of the loan. 2. The loan interest rate is reduced by 3% in the first year, 2% in the second year, and 1% in the third year. For example, a 5% mortgage would be just 2% in year 1. 3. After the buy-down period ends, the lender charges the full interest rate for the remainder of the mortgage term. 4. Buy-downs are often used by sellers, including home builders, to help buyers afford a property. Hope this would help. Thanks for watching.